The other possibility that I've been looking at is all the speculation we've had. Not really interested in the guts of the economy, the broad economy. They're interested in these fairly narrow speculative areas. I come away and I rate a soft landing as a 50 to 60% probability, and a recession is 40 to 50%.
Dr. Gary Shilling, president of Gary Shilling Co., an economic consulting firm and registered investment advisor. It is so wonderful to see you again and to welcome you back to the show. Thank you so much for taking the time to join us this morning, Dr. Shilling.
My pleasure.
Well, we are recording on Friday, November 1st. It has been quite the busy week as it relates to economic data. So I can't think of a better guest to have. And we're going to air this as a Saturday morning special here for the folks watching and listening. But let's start where we always start, Dr. Shilling, and that is with that big picture, more of that macro view, where we are today as it relates to the economy. We can throw markets in there. And as you know, Dr. Shilling, on this show, you can take all the time you need to set the table when it comes to that economic picture.
That's great. That's great. That's great. Well, the primary focus recently has been on the labor markets. And of course, today we just got the October employment numbers. They were distorted by the strikes and the hurricanes, but they still were weak, and the revisions were down. And I think it simply shows that the labor markets are easing. Now, they're not falling apart, but they are easing. And of course, a lot of this is simply the aftermath of the very strong hiring that took place right after the pandemic. And I mean, for example, in the tech area, there was huge hiring of everybody who had a warm pulse, and they've had software engineers. Matter of fact, we just put out today our monthly newsletter Insight, and we've got a graph in there that shows software engineers employment, which is just going off the cliff. So you've seen a lot of the excess hiring earlier, which has been retraced. But on top of that, I think it's fair to say that labor markets are easing, and that is of particular concern to the Fed. That's been their principal concern. They're less concerned about inflation, and we know that because they trumpeted the 2% inflation target, and they didn't get there before they cut rates in September by half a percentage point. So we know that they have thrown in the towel on their pledge to stick to tight credit until they got back to the inflation number they wanted. And it shows that they are concerned, and concerned particularly about labor markets. So that's been the central focus. And the data has been obviously distorted, again, by the hurricanes and strikes and so on. But it is showing a softening labor picture. And of course, the Fed worries about softness going all the way to recession. That has not occurred yet, of course, but that is what they worry about.
Mm-hmm. All right. So speaking of the Fed, we did have the September rate cut of 50 basis points. I take it this probably, we have a Fed meeting next week. Well, what do you
Yeah.
I'm curious, like how you're thinking about the Fed, what this could mean for their rate policy.
Well, I think the betting now is that they're going to reduce rates, their policy rate, which is the overnight federal funds rate, by 25 basis points, half of what they did back in September. Earlier, there was a feeling they were going to cut twice before the end of the year. I think that's pretty well gone out the window in terms of forecasts. And so I think the expectation is that they'd cut 25 basis points. But that's, whether that has an immediate effect on labor markets remains to be seen. It can have an effect on sentiment, no question about that. But whether it actually affects labor markets, I mean, if you looked at the average employee in this country and you said, what do you think had happened to your job if the Fed cut interest rates by 25 basis points or 50? They first thing they'd say is, what's a basis point? I mean, this is just not a relevant number for most people in this country. The effects of it can be, if it has a demonstrable effect, but it's not the kind of thing that you and I think about all the time is not really what's down there where the tire meets the pavement.
Yeah, it's a good point. So on the labor side with its softening, how do you kind of step back and think about more of the state of the economy? What's your assessment of the economy? Is it a healthy one?
The real question is, are we simply seeing a slowdown and the so-called soft landing, or is this going to deteriorate into a recession? Now, I define a soft landing as a time when the Federal Reserve raises interest rates. They go through a campaign like they did for about 2 years, and then they cut rates. And you never know that they're through with their rate raising campaign until they cut them. They may be simply pausing. But when they cut them and there's no recession, that's a soft landing. Now, by that definition, there's been only one in the entire post-World War II period, and that was in the mid-90s. Now, what really makes the difference between a recession and a soft landing? As a matter of fact, we cover that in detail in our October Insight, which is just out, and it really depends on what other imbalances are in the economy. The Fed raises rates when they think something is getting out of whack, and it's usually they look at an overheating economy, inflationary tendencies, and so on. But and that in itself doesn't mean a recession. But if you have a lot of imbalances, like if you go back to the early 70s, you had a whole huge inventory building. That collapsed when the Fed raised rates, but it was going to collapse anyway. That was a 73, 75 recession, the most severe since the 30s at that point. Then you got to the dot-com collapse in the late 90s, and that's when you had these companies that went public with no earnings, no sales, only a business plan, and that was, again, the Fed raised rates. There was a brief recession, but what was really going on was a correction of this wild dot-com speculation. And of course, more recently, we saw this with the subprime bonanza in the early 2000s, where everybody was buying houses and they never were going to have to meet a mortgage payment because the house would appreciate. They could refinance, take money out of the deal, et cetera, et cetera. And that collapsed and really threatened Wall Street. It took huge bailouts by the federal government and the Fed. But that was the imbalance. So what you really, my feeling is you've got to look for those imbalances on top of the Fed tightening. The Fed's tightening for a reason. But if you're going to see anything really severe happening, it's got to be imbalances. Now, at the present time, do we have any big imbalances? And I've made a career out of looking
yes,
for the
you have. Yes, you have.
looking for the hidden flaws, and I don't see any right now. Now, there are a couple of things that you can point to that are out of whack. One of them is the problem with office buildings. When the pandemic came along, people stayed home. Employers have been trying to get them back to the offices. You have like Amazon, they just laid down the law and they said, you're either at your desk 5 days a week or you're out. And other companies are doing the same thing. But the office vacancy is still around 50%. And is that big enough to sink the ship? It's nothing like the subprime mortgage problem. It's real estate, but it's a relatively small combined area. The other possibility that I've been looking at is all the speculation we've had, the Magnificent Seven, all the crypto stocks and so on, with people not really interested in the guts of the economy, the broad economy. They're interested in these fairly narrow speculative areas. But again, I'm not sure that that's so extreme that the correction of that would lead to recession. So I come away and I rate the a soft landing as a 50 to 60% probability, and a recession is 40 to 50%.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028 when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut, and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. In the recession, you would have to have the imbalances, and the only kind of two on your radar at the moment are the commercial real estate, and as you point out, like these kind of sky high valuations amongst these magnificent seven. Yeah. Interesting. Well, you are someone, you pointed out, who is known, even just ticking through some of the past ones, major calls like the 1973 to 75 recession. You nailed that one. You nailed the dot-com bubble, housing. There's a bunch of others that I'm not listing here that you certainly nailed. And I think we've talked about this. Sometimes folks characterize you as a contrarian, but that's not necessarily a fair characterization.
No, it isn't. It isn't. A contrarian, by my definition, is somebody who always against the consensus. Whatever the consensus says, they take the opposite. I'm not in that. I'm not in that camp. There've been times. It's for example, back in the early '80s. People thought inflation was going to last forever, and stocks and bonds had been beaten up. And I said, "Hey, inflation is unwinding, and we're going to see dramatic rallies in both stocks and bonds." It was non-consensus, but it wasn't completely negative in that. But I think that the difference between the contrarian and my view is I'm looking for those imbalances, because the consensus view is pretty well discounted in stock prices and other markets. In other words, it's worked in there. You're not adding any value by rehashing the consensus. It's already in there. Nobody ought to pay anybody like me for doing that. But where I think you earn your keep is where you find significant things that, first of all, they got to be significant. They can't be trivial that are going to be revised out in the next month's data. Secondly, they've got to be non-conventional. In other words, they're not really appreciated. And of course, third, they got to have a good chance of happening, because ultimately you're judged by your forecasting record. But those three characteristics are the things that I'm looking for. And those don't come along all that frequently. I mentioned three of them. And of course, usually these calls are on the downside, because the majority of forecasters, and certainly in Wall Street, are paid to be bullish.
Yes.
And I know that myself. I got fired twice by Don Regan, who was president of Merrill Lynch, for forecasting recession. It happened, but it wasn't being bullish on America in the Merrill Lynch slogan. So it's to make a non-consensus call that's going to amount to anything, you almost always have to be bearish, because the herd, the consensus, is paid to be bullish. They're on the other side.
Mm-hmm. Yeah. I do remember that story about you being fired by Don Regan twice, because Merrill Lynch acquired a firm that you were
White Wild. Yeah,
that's right. Yeah. Let me ask you this, just about economic forecasting. As an economist, would you say, is it more of an art than a science? And I don't know if that's a terrible question, but I'm a bit curious about the forecasting aspect of an economist.
Well, it is a science until it can become an art. Mm-hmm. Now, when I started out in this business many years ago, there was a conviction that if you could write enough equations, you could solve the economy. And these were these big econometric models. And I started off, I was a physics major as an undergraduate. So when I got to Stanford working on a PhD, I gravitated toward this. And we're dealing with these huge models, 500 or 600 equations. And the whole idea is that you are describing the economy in all its details. And all you needed is a couple of outside exogenous variables, and then you turned on the model and it spewed out these results unsullied by human hands. That was the theory. Well, they didn't work. They didn't work. There was always where something happened. They blew up, meaning they gave nonsensical results, and they really didn't work. Now that doesn't say that sometime in the distant future, long after I'm gone, and maybe even you, that we're going to have the ability to write enough equations and describe things completely enough that you can make those kinds of forecasts. But the economy is just too complicated. So it really boils down to judgment, experience, Kentucky windage, use that term, and it's and the forecasting it remains an art, at least for now. Now the other aspect of this is that let's say that you developed a perfect model for forecasting the stock market. Okay, it worked absolutely 100%. Okay, what would happen? Well, you'd start making zillions of dollars, but the word would get out.
Yeah.
And other people would start doing the same thing. And when they did that, it would change the database on which that model is formulated. In other words, it no longer would work. And as a result, this you would not be able to develop that long-term capital management. I don't know if you remember that.
Oh yes, I read the book when Genius Failed, but I was definitely in elementary school at the time. So
there was a case of where those guys figured they had all these Nobel Prize economists working on it, and they figured that they could perfectly model the market and financial markets and make a zillion in fixed income securities. The problem was, though, that they became the market. There was nothing outside to play against. They were it, and so they tripped on their own underwear. I mean, it was a classic case. But those guys were bright, but they didn't stop to realize that by having the success they did initially, that they were changing the whole environment on which their models were based, and consequently, the models weren't going to work. And of course, they didn't.
I want to bring up something else with you because you mentioned just going through some of your calls that were maybe seen as contrarian. In the 80s, the bond market rally of a lifetime, which you nailed. I get a lot of questions nowadays about the bond market. I think a lot of folks who watch this channel, they are interested. This is an area where you have a deep expertise. I know a lot of folks look at you, especially folks who are like more duration managers. Can you help us understand what's happening in the bond market, where you see things headed? Just would love to kind of leave it a bit more big picture, open-ended for you.
Well, first of all, you got to realize that the majority of Wall Street wizards are always opposed to the bond market because they know that when bonds are rallying, prices are going up because interest rates are falling, it usually means bad news for stocks. And their primary interest is in stocks. So they start off with a bias on this. They're looking for reasons that the bond market cannot rally, prices cannot go up. And you mentioned this. I started out in the early 80s saying we're entering the bond rally of a lifetime. And the yields on the 30-year bond at that point were 14.6%. Now they're 4.3%. And the appreciation in bonds has outperformed the S&P during that long period. But as I say, there's a tremendous bias against bonds. And also the commissions on bonds are not nearly as high as stocks. Of course, the commissions are pretty well going away on stocks as well. But a lot of people, stocks are a lot more fun. You can go to a cocktail party and talk about some little company that you bought, and it's a 10-bagger. It went up 10 times. You can't say that about bonds. They're not that exciting. They're kind of dull. So there's a lot of reasons that people are opposed to bonds. Okay, that's the background. And all I can say is that all the way down in interest rates from the early 80s, bond yields, and all the way up in bond prices, the consensus was entirely opposed. It can't last. It won't. It won't really continue. There's no way that interest rates are going to continue to fall. So, I don't feel uncomfortable being opposed by the consensus because they've got a bias there to start with, as I explained. Now, where do we stand now? That's all background. Where do we stand now? Well, we got to very low interest rates, bond yields, before the with the pandemic, and then of course what happened was that with the revival of the economy, and then of course more importantly the Fed's tightening, bond yields with other interest rates rose. Now they've actually declined a bit in the course of this year, not a lot, but they're lower now than they were at the beginning of the year. And the question is, are they going to go down back to those early lows? Are we going to see 2% yield on a 30-year Treasury? I don't think so. I don't think so, because if you look at inflation, 2% inflation probably is where you can expect to get. I'm not sure you're going to get a lot lower than that. You do have some deflationary forces. A big one, of course, is globalization. But China is now in trouble. You're not seeing quite the downward pressure on goods prices because of leaping Chinese production and other factors. So I'm not sure you're going to go down to zero inflation. But let's say you've got 2% inflation as the norm. And that isn't because it's the Fed's target, but that's just the way I think the economy is shaping up. And then you add 100 basis points premium for yields on the 30-year bonds. It gets you to 3%. Your now yields are a little over 4%. So it says you do have a rally. And if Treasuries rally 100 basis points, in other words, yields go down 100 basis points, you make about 30%. If that happens in a year, the coupon, the interest plus the appreciation, you make about 30%, 20 to 30%. So there is some juice left, but it's nothing like what we had before. And say the yield on bonds. And I, by the way, I've never bought bonds for yield. I don't care what the yield is, as long as it's going down. Because when the yield goes down, the price is going up. And that's the same reason most people buy stocks. I don't think many people buy, some institutions need to, but most investors, individual investors, don't buy stocks for the dividend yield. They buy them for appreciation. That's what they're interested in. And that's the same attitude I have toward bonds, and why there is this feeling of you can only own bonds for yield. No, I own them for appreciation. And of course there is the other I think misconception is that you buy a bond, you got to hold it to maturity. I remember years ago when my parents were still alive, I was running their portfolio, and my mother called me up and said, "Well, Gary, I see you put some bonds that aren't going to mature for 30 years in our portfolio." And she said, "Dad and I aren't going to live for 30 years." And I said, "Yeah, Mom, but you're not going to necessarily own them for 30 years. I mean, you say, what's the maturity on a stock? Well, unless the stock is called or the company goes bust, what's the maturity? It's infinity, right? There is no maturity on a stock. So this idea of bonds are all that different from stocks, I think this is just a misconception.
Yeah. Well, I that's why I love this show, is just so we can all learn these things. So let me ask you this. You also manage money. You're an RIA. How are you thinking about what opportunities in this environment are interesting? What do you want when it comes to portfolio construction? I don't even know what you can share as it relates to that, but let's talk about the areas that are of interest to you.
We spell out our portfolio position in our monthly newsletter. There's no secret about it. Okay. We're long treasuries. We're long the dollar against other currencies. I think it's a safe haven. And when you've got a period of problems, that's where people go. They go to treasuries and they go to the dollar. we're short some commodities, copper in particular. I like copper on the short side because copper goes into almost any manufactured goods.
Mm-hmm.
Whether it's machinery or cars or appliances, even at computer terminal you got in front of you, that's got some copper in it, believe it or not.
Oh, yes.
So copper is a good measure of industrial production. They say it's the queen of industrial metals. So we're short copper, and then we've also are excuse me have long positions in India using ETFs. India, I think, in the long run, and we've written about this extensively over the recent years. I think India, in the long run, is a better shot than China. Um, India, for example, has no limitation on population. China's got a severe problem. The earlier one child per couple policy means that the working age population in China is going to decline for the next 4 decades. They can't do anything about that. And matter of fact, their attempts to encourage more births have fallen flat. So India does not have a limit on population. Now, having a limit on having unfettered births is not the same as having people that are productive. But the Indians are very good at software. Uh, China is basically thrives on goods, producing goods, consumer goods, particularly that get exported to the West. And of course, they've got problems now with the West not being too happy about China because of their military attitudes and so on. So there is limitations, but goods, you can only put so many cars in your driveway. But services, you can spend almost infinite amount of money on travel, recreation, medical service, and so on. And the Indians are very good at that. So that's a second advantage of India over China. India has widespread use of the English language. They inherited that from the British. And that's pretty handy in today's world where English is the international language. They also have a legal system they inherited from the British. Now, it's pretty messy. I mean, you and I would not want to be tried in an Indian court, but compared to China, where it's all kangaroo courts, there's nothing like a fair trial in China. So I think there are a number of advantages that India has over China, and so that's an area that we've interested in via ETFs is Indian stocks.
Mm-hmm. That's interesting. And then just another topic, but I think I recall you're agnostic on gold. Is that right?
That's correct.
Okay, got it. I just had to ask because it does come up. At least a lot of folks in the comment section will bring it up as well. Okay, so we've talked about some opportunities abroad as well. Let's come back to the U.S. We have the elections on next Tuesday. Maybe from an economic lens, how are you thinking about the upcoming U.S. election, potential outcome scenarios, what that could mean for the economy? I take it you've probably looked at policies as well, but we can keep it from an economic lens.
It's comic relief. It's comic relief. I mean, you've got Trump who is full of himself, a real baggard, and then you got Harris who doesn't really say anything. You don't know what she thinks, if anything. She's much more liberal than Trump, of course, and Trump is more conservative than Harris. But you don't know what's going to happen because the presidential election is important. And the president does control. I mean, the federal government spending is about a quarter of the total economy. So via all the agencies and bureaus and so on, the president does have a lot of control on the economy. It isn't just what gets passed legally by Congress. So you can't neglect that. But still, you do have Congress to deal with. And, there's the Congress, it looks like it's going to be a pretty close vote. I think the betting now is that the Republicans will take the Senate. The House will be up for grabs. But the point is, if you have a split government, it does tend to deter big actions. You can't get things through, even if the president, whoever it is has strong backing for them. So I think you're dealing with a situation now where it's probably status quo is as good a forecast as any about what's going to happen in Washington.
Yeah, we do have a huge debt and deficit problem. I wonder at
Well, you
some point
do,
when that's going to matter.
and we've been yelling and screaming about that for a long time, but it doesn't bother anybody. It doesn't bother. I mean, you talk at Harris and Trump. Neither of them said anything about the deficit and debt, and the public doesn't really care. And as long as they're shoveling money out the door, hey, I want my share of graft and corruption. I want my goodies. We've done work on that, and what we described as a debt bomb. Now, a debt bomb is basically occurs when the when the debt gets so big that the interest on the debt, which is a component of the deficit, becomes so huge that it grows exponentially, that it really grows without control and takes off. Now we are the way we look at it is government interest payments as a percentage of GDP. It's now about 3%. That's back to the level it reached in the mid 1990s. That was the previous peak. We're now back there. You don't know how far you can go. Obviously, the Treasury's issues needed to finance the debt are being issued with gay abandon, and foreigners are lusting after Treasuries, as our domestic investors. There isn't any resistance to this. This isn't Argentina, where you get to the point that nobody wants to buy the government paper, and you got to do something. We have the privilege and of being having the world's currency, and we can inflict all kinds of abuses on the financial system because people don't really have any choice. I mean, for example, when we have a huge trade and current account deficit, that means that all those dollars are being pumped out and end up in foreign hands. Now, what are they going to do with them? What are the foreigners going to do with them? They got to invest them in U.S. dollar-denominated assets. There's no option. If a Chinese say we don't want them, we'll sell them to the Swiss. Well, then the Swiss have them. What are the Swiss going to do with them? Somebody's got to eventually buy U.S. denominated securities. Now, they can determine the price at which they want to buy them. They're not entirely subjective to what's happening in Washington, but they really got to recycle. The only alternative is to convert them into paper dollar bills, cut them up with the scissors, and flush them down the toilet, which nobody's going to do. They really are stuck with this. And as long as there is a credibility in the dollar, and there's really no alternative. I mean, it's not the euro. The Chinese would like their yuan to be a global currency, but they want to control it. And foreign investors always run away from controlled currencies. That's not attractive. And the Japanese yen, they don't want it to be a world currency. There's really no alternative. So rightly or wrongly, you really have a situation of where they're running these uncontrolled deficits and debt, and we're not to the debt bomb problem, at least not yet. And you sort of say, hey, I'm not very happy about this because I think a lot of government spending is non-productive and distorts the economy, but that's where it is.
Yeah. Well, yeah, certainly something that we will definitely keep talking about on this program. I have to say, Dr. Shilling, it is always a pleasure having you on. I want to give you the final few moments here. Let folks know where they can find more of your work, where they can subscribe to Insight. I know you have a toll-free number they can also call. And any parting thoughts?
Yeah, we do. We just came out with our October Insight, and if anybody would like to take a complimentary copy, our toll-free number is 1-888-346-7444. And our 888-346-7444 toll-free number. Our website is www.agaryshilling, AGARYSHILLING shillingco.com. So if anybody's interested, you can take a look.
Well, Dr. Gary Shilling, always a pleasure having you on. I appreciate you being so generous with your time, your knowledge, all of your wisdom, your ideas. And until next time, be well, Dr. Shilling. Thank you so much.
Thank you very much. And you too.